Today we're going to discuss Chapter 9, Accounting for Asset Retirement Obligations and Asset Impairment. As discussed in Chapter 6, AROs, or Asset Retirement Obligations, are future costs necessary at abandonment. This can include the dismantlement, abandonment, or reclamation costs. We're going to capitalize these costs to the asset, and they're going to be included in the DD&A calculation each year. So to record and recognize the ARO liability, so again, this is a liability recognized for future dismantling and retirement of a long-term asset. We're going to debit the long-lived asset, and we're going to credit the ARO liability. And again, this is going to be included in the cost of the asset and then in the future DD&A calculations. A couple definitions that we need to cover. Retirement is an other than temporary removal of a long-lived asset from service that includes the sale, abandonment, or other disposal. It does not include temporary idling. An impairment, the condition that exists when the carrying amount of a long-lived asset or asset group exceeds its fair value. Typically, this is grouped at the field level. So to test for impairment, there's a three-step approach that we're going to use. First, you would test for recoverability, and this is only if certain indicators are present. Then the carrying value is compared to the undiscounted future net cash flows to determine if it's impaired. If it is, then the loss is measured by comparing the carrying value of the asset to the fair value. That would be the discounted net cash flow. So step 1, looking for impairment recoverability. So again, only if events or circumstances indicate that the value may need to be written down, there may need to be an allowance set up, and it may not be recoverable. For example, significant decrease in the market price of the product, significant adverse change in the physical condition, significant adverse change in legal business environment, significant cost overruns during the construction or development phase. Cash flow losses indicate continued losses or probable that the asset will be sold significantly prior to the end of its life. This does not include temporary decrease in selling prices. So if one of these indicators are present, then you would go to step 2, the impairment test. For example, Tyler Company, a successful efforts company, has capitalized costs of $120 million. In 2013, the government enacted a new tax triggering the need for Tyler to test for impairment. So we have net capitalized costs of $120 million, expected undiscounted cash flows of $109.68 million. The fair value, or the discounted future net cash flows, are $95.07 million. So we're going to look at our impairment test. We're going to compare the net carrying value of $120 million to the expected undiscounted cash flows of $109.68 to determine, is there impairment? And for this example, the answer is yes. So then we would go to the third step to measure the impairment loss. So we're going to compare the net carrying value of $120 million to the expected discounted cash flows of $95.07 million. So the amount of the impairment is calculated at $24.93 million. Our journal entry is going to be to debit impairment loss for $24,930,000 and to credit the allowance for impairment $24,930,000. This concludes Chapter 9.